Right now, as you're reading this, there's a $680 trillion bomb quietly ticking inside the global financial system. That's not a typo. $680 trillion in derivative contracts, interconnected bets, leveraged positions, and counterparty dependencies so complex that even the people managing them don't fully understand the ripple effects if just one major piece breaks. To put that number in perspective, that's 9 times the entire global GDP. The entire economic output of every country on Earth, multiplied by 9, exists as leveraged financial exposure in the banking system. And here's the truly terrifying part. The headline event is never the real cause. When Silicon Valley Bank collapsed in March 2023, losing $42 billion in 48 hours, the media said it was poor risk management. When Credit Suisse imploded weeks later, needing a $54 billion emergency merger, they called it loss of confidence. When First Republic went down requiring a $30 billion rescue, the narrative was regional banking stress. All lies. Well, not lies exactly, but incomplete truths designed to keep you calm. The real story? These weren't isolated failures. They were stage 3 cracks in a 4-stage pattern that has repeated itself for literally thousands of years. From ancient Rome to Renaissance Europe to the 2008 financial crisis, the pattern never changes. Only the costumes do. And if you understand this pattern, you can see what's coming before 99% of people even know something's wrong. Here's what's actually happening right now in 2026. Global debt has reached $315 trillion, up from 190 T in 2008. Commercial real estate is sitting on $1.5 trillion in maturing loans that can't be refinanced at current rates. Major banks are holding $620 billion in unrealized losses on their balance sheets, losses they haven't admitted yet. The Bank Term Funding Program, the emergency facility created to stop the 2023 banking panic, just quietly injected another $152 billion into the system. And the derivatives market I mentioned? It's now larger than it was before 2008. But the mainstream media won't tell you this. Your banks certainly won't tell you this. And the politicians who depend on your confidence in the system will actively work to hide this from you. So let me tell you, in the next 30 minutes, I'm going to show you the exact 4-stage pattern that shows up before every major banking collapse in history. Where we are right now on that timeline, spoiler, late stage 2, sliding into stage 3, the specific signals to watch that tell you when stage 4, the full crisis, is about to kick off. Why this crisis could make 2008 look like a practice run, the math is genuinely scary. What you can actually do to protect yourself before the crowd panics. Because here's the uncomfortable truth. By the time the public agrees this is a crisis, the wealth transfer is already complete. The people who win during these moments aren't the smartest. They're the ones who saw the pattern early and positioned accordingly. So let's dive in, because once you see this framework, you can't unsee it. And that knowledge might be the difference between surviving what's coming and getting completely wiped out. The 4-stage pattern, the script that never changes. Across thousands of years and dozens of major financial collapses, the pattern is so consistent, it's almost mechanical. Different actors, different technologies, different currencies, but the same 4-stage play. Let me show you the framework, then I'll prove it with examples spanning 2,000 years. Stage 1, stability, the setup. This is where everyone feels safe. The last crisis is in the rearview mirror. Reforms were made, regulations were passed, lessons were learned. The psychology, we're smarter than the past. We fixed the problems. This time is different. What actually happens? Safety breeds comfort, comfort breeds trust. Trust breeds lending. Lending breeds expansion. The trap. Risk never disappears. It just hides. And comfort makes people forget to look for it. Current evidence we completed. Stage 1. Post-2008. Federal Reserve dropped rates to near zero, 2008 to 2015. Dodd-Frank regulations passed, 2010. Bank stress tests, implemented public narrative. Banks are safer than ever. Markets recovered. Confidence returned. Timeline. Stage 1 typically lasts 5 to 10 years after a crisis. We're now 15 plus years past 2008. Stage 2, overreach, the buildup. This is the longest stage, which is why most people fall asleep during it. Everything looks fine on the surface, but underneath, the foundation is rotting. The psychology. Growth is natural. Leverage is efficient. Complexity is sophistication. What actually happens? Credit grows faster than real economic output. Leverage creeps up gradually, then suddenly, risk gets sliced, diced, repackaged, and sold as managed risk. Complexity becomes camouflage for fragility. Warning voices get dismissed as perma-bears or fearmongers. The trap. Stage 2 can last a long time. Years, even a decade. This makes people believe it's the new normal, not a bubble. Current evidence we're in late stage 2. Debt explosion. Global debt. $315 trillion on forced 22% of global GDP. U.S. government debt. $35+ trillion, growing 1T per $100 days. Corporate debt. $13.5 trillion, much of it needing refinancing soon. Consumer debt. $17+ trillion, whereas credit cards at record highs. Leverage indicators. Margin debt in stock market, near all-time highs. Private equity leverage, 6-7x, EBITDA, historically 4-5x. Hedge fund gross leverage, approaching 2007 levels. Complexity, red flags, CLOs, collateralized loan obligations, $1.4 trillion market. Sound familiar to 2008's CDOs? Structured products with embedded leverage and derivatives. Shadow banking system, $63 trillion, larger than traditional banking. Timeline. We've been in stage 2 since approximately 2015. That's 11 years. Historically, this is long, which means we're overdue for stage 3. Stage 3, the crack, the reveal. This is the moment something breaks. A default, a bank run, a rate shock, a geopolitical event. Critical insight, the crack is not the cause. The crack is the reveal. It exposes the weakness that was already built into the foundation during stage 2. The match doesn't create the gasoline, it just lights it. The psychology, this is an isolated incident. Regulators have it under control. Don't panic. What actually happens? Hidden losses suddenly become visible. Confidence evaporates faster than anyone expected. Liquidity disappears as everyone tries to get to cash simultaneously. Contagion spreads through interconnected exposure. The trap, authorities will initially downplay it. They must downplay it to prevent panic, so the early warnings get dismissed. Current evidence we're entering. Stage 3, March 2023. Banking crisis, Silicon Valley Bank, 209 buys in assets, collapsed in 48 hours. Signature Bank, 110 Bs in assets, seized by regulators. First Republic, 233 buys in assets, failed despite 30 buys to lifeline. Credit Suisse, 167-year-old institution. Emergency merger, unrealized losses. FDIC data, Q3 2023, $684 billion in unrealized losses on bank balance sheets. These are losses on safe assets like government bonds that dropped in value when rates rose. Banks don't have to report them until they need to sell commercial real estate time bomb, $1.5 trillion in CRE loans maturing 2024-2026. Office vacancy rates, 20% plus in major cities. Valuations down 30 to 50% from peak. Regional banks hold 70% of CRE exposure. Emergency measures. Bank Term Funding Program, BTFP, created March 2023 as temporary measure, already lent $152 billion as of January 2026. Allows banks to borrow against underwater bonds at par value, pretending they're not underwater. This is a band-aid, not a fix. Timeline, stage 3 can be fast, weeks, months, or slow motion, 1-2 years. We're currently in the slow crack phase. Multiple small breaks, each supposedly contained. Stage 4, contagion, the crisis. This is what people think of as the crash. But by the time you're in stage 4, it's too late to prepare. You're in survival mode. The psychology, how did this happen? Nobody saw it coming, and we need to save the system. What actually happens? Funding markets freeze. Banks won't lend to each other. Asset fire sales, forced selling at any price. Bank runs, digital or traditional. Counterparty failures cascade, government central bank intervention, currency debasement, printing money to absorb losses, wealth transfer from many to few. The trap. The rescue often becomes permanent. Emergency measures that were supposed to be temporary become structural, and the public pays through inflation, bail-ins, or austerity. What stage 4 looks like, we're not here yet, but getting closer. A major systemically important bank fails or requires nationalization. Credit markets seize up. Even good borrowers can't get funding. Stock market crashes 30-50% plus in compressed time frame. Central banks announce unlimited liquidity. Government guarantees expand dramatically. Too big to fail becomes everything is too connected to fail. Historical timeline. Once stage 4 begins, the acute phase lasts 3 toward 18 months, but the economic damage lasts years. Historical proof. The pattern. Across 2,000 years now, let me prove this isn't theory. I'm going to show you 3 examples separated by centuries, different continents, different technologies, but the exact same 4-stage pattern. Example 1, Rome, 33 AD, the ancient banking panic. Most people don't know. Rome almost collapsed from a financial crisis, not a military defeat. Stage 1, setup. Roman credit system was surprisingly advanced private lenders, argentari, operated across the empire. Real estate speculation in Rome and provinces. Decades of stability created confidence. Stage 2, buildup. Credit extended far beyond solid collateral land prices, inflated by speculation. Lending standards deteriorated. Complexity. Loans secured against loans secured against property. Stage 3, the crack. Emperor Tiberius enforced old law requiring lenders to invest 2 per 3 of capital in Italian land. Lenders had to comply quickly, so they called in loans. Borrowers couldn't pay, forced to sell property for cash. Too many sellers, no buyers. Property values collapsed. 40 to 60% collateral backing loans evaporated. Stage 4, contagion. Credit markets froze completely. Even wealthy individuals couldn't access liquidity. Banks failed across the empire. Tiberius had to inject 100 million sesterces, massive emergency fund. Special lending program created to restore liquidity. The outcome? Rome's economy contracted severely. Wealth transferred from indebted landowners to cash holders and those who bought collapsed assets cheap. Sound familiar? Example 2, the Medici Bank collapse, 1494. Renaissance banking crisis. The Medici were the J.P. Morgan of Renaissance Europe. Their collapse nearly took down the entire European banking system. Stage 1, setup. Medici Bank built reputation over 60-plus years, trusted across Europe, financed kings, popes, merchants, symbol of stability and sophistication. Stage 2, build-up. Expansion into riskier borrowers, especially royalty. Problem, kings don't like to pay back loans. Concentration risk, too much exposure to English monarchy. Complexity, branches across Europe with cross guarantees. Stage 3, the crack. English King Edward IV defaulted on massive loan, 1478. Louis XV of France refused to repay, 1480s. These weren't isolated incidents. They were exposures the bank couldn't absorb. Stage 4, contagion. Depositors across Europe questioned, is my money safe? Bank runs spread from city to city. Medici branches closed sequentially. London, Bruges, Lyon, Rome. Reputation built over generations destroyed in months. Other banks failed in sympathy. Credit contracted across European economies. The outcome? The Medici Bank, 100-plus years old, completely collapsed by 1494. The family survived through political power, but their banking empire was gone. The lesson? No institution is too big to fail or too trusted to collapse. Leverage and bad loans eventually catch up, regardless of reputation. Example 3, the 1929 crash and Great Depression, modern banking collapse. Everyone knows about 1929, but most don't understand the 4-stage pattern that created it. Stage 1, setup, post-BWI economic boom, roaring 20s. Prosperity is permanent mentality. New technologies, radio automobiles, created optimism, stock market, smaller wealth creation machine. Stage 2, build up, extreme leverage, buying stocks with 10% down, 90% borrowed, margin. Banks lending to brokers, lending to speculators. Florida real estate bubble 1925 should have been warning concentration. Small number of banks holding most of the risk. Complexity, interlocking ownership, and cross guarantees. Stage 3, the crack. October 24th, 1929. Stock prices drop, triggering margin calls. Margin calls force selling. Selling pushes prices lower. Lower prices trigger more margin calls. Vicious cycle accelerates stage 4, contagion. Banks had lent heavily against stock collateral, now worthless bank failures. 9,000 plus. Banks failed 1930, 1933. Deposits disappeared. No FDIC insurance yet. Credit vanished. Businesses couldn't get working. Capital unemployment hit 25%. GDP contracted 30%. The outcome took 25 years for stock market to recover to 1929 highs. Entire generation scarred. Massive wealth transfer from leveraged speculators to cash holders and those who bought assets at depression lows. Key insight, the stock crash wasn't the problem. The crash exposed the banking system's fragility. Stage 4 was the banking collapse that followed. Where we are now, the 2026 reality check. Now that you understand the pattern, let's map exactly where we are today. And I'm going to be very precise about this. We are in late stage 2 with multiple stage 3 cracks already visible. Let me prove it with current verified data. Stage 2. Evidence. The buildup is extreme global debt levels. Total global debt, $315 trillion. Source, IIF, Global Debt Monitor, Q4, 2025. This is 422% of global GDP. For comparison, 2008, pre-crisis, 280% of global GDP. We are 50% more leveraged than before the last crisis. U.S.-specific federal debt, $35.2 trillion. Source, U.S. Treasury, January 2026. growing at $1 trillion per 100 days interest payments alone, $1.1 trillion annually, more than defense spending. Corporate debt, $13.5 trillion. Source, Fed data. 40% of that debt needs refinancing in next 3 years at much higher rates. Derivatives. Exposure, global derivatives, notional value, $680 trillion, BIS, December 2025. To understand this, if even 1% goes bad, that's $6.8 trillion in losses. 2008's entire crisis was triggered by $1 to $2 trillion in bad mortgage debt. This is 3.7x larger shadow banking. Non-bank financial institutions now control $63 trillion in assets. These institutions have bank-like risks, but less regulation. Money market funds, private equity, hedge funds, all interconnected with traditional banks. When stress hits, shadow banks can't access Fed emergency windows. Initially, stage 3 evidence. The cracks are showing banking stress, 2023 2026, March 2023, cluster. Silicon Valley Bank, assets, 209B, collapsed in 48 hours. Signature Bank, assets, 110B, seized by FDIC First Republic, assets, 233B, failed despite 30 by emergency injection Credit Suisse, assets, 575B, forced merger with UBS. The official narrative, isolated incidents, poor management, system is stable. The reality, these failures revealed systemic vulnerabilities. Interest rate. Risk, when Fed raised rates 5% in 18 months, bond portfolios collapsed. Deposit flight. Digital banking enables bank runs at smartphone speed. Confidence fragility. Once depositors doubt safety, billions leave in hours. Contagion. Failure of one triggers examination of others. Unrealized losses on bank balance sheets. FDIC data, Q3 2025. $620 billion in unrealized losses. What does this mean? Banks hold safe government bonds and mortgage-backed securities. When rates rose, these bonds dropped in value. Banks don't have to report losses until they sell. If depositors demand cash and banks must sell, losses become realized, capital depleted, bank fails. This is exactly what killed SVB. Commercial real estate crisis, current situation, verified data, $1.5 trillion in CRE loans maturing 2024-2026. Source, Morgan Stanley. Office occupancy, 50 to 60% of pre-pandemic levels. Office values, down 50% from 2019 peaks. Problem. Loans were made based on 2019 valuations. Regional banks hold 70% of CRE exposure. Source, Fed data. The math doesn't work. Property worth $100 million in 2019, loan of $70 million, property now worth $60 million, loan still $70 million, loan matures, needs refinancing. At higher rates, property cash flow can't support new loan. Result, default or bank takes loss. Estimated potential losses, $400 billion. This is a slow motion crisis unfolding right now. Corporate debt refinancing. Wall, $4.5 trillion in corporate debt. Maturing 2024 to 2027, average rate when issued, 2 to 3%. Current refinancing rate, 6 to 8%. Many companies borrowed assuming low rates forever, now facing 2 to 3x higher interest costs. Earnings don't support higher debt service. Result, defaults will rise. Emergency measures. Already in place, Bank Term Funding Program, BTFP, created March 2023 as temporary emergency facility, allows banks to borrow against underwater bonds at par value. Translation, pretends losses don't exist. Amount lent so far, $152 billion as of John 2026, originally set to expire March 2024. Extended indefinitely. This is not normal. This is life support. Why this setup is more dangerous than 2018 now. 1. Scale, 2008, $15 trillion in global debt. 2026, $315 trillion in global debt, 21x larger. 2. Interconnection. Derivatives, web is tighter. Global banking is more integrated. Digital systems enable faster contagion. No country can isolate from global financial stress. 3. Limited tools. 2008, Fed could cut rates from 5% to 0%. 2026, rates only at 4 to 5%, less room to cut. 2008, government debt 60% of GDP. 2026, government debt 120% plus of GDP, less capacity to rescue. 4. Public awareness, 2008, surprised most people. 2026, people are watching, which means faster bank runs when fear hits. 5. Asset valuations, 2008, stocks and real estate overvalued. 2026, stocks, real estate, bonds, private equity, all overvalued simultaneously. Fewer safe havens to hide. The signals, how to see stage 4 coming. Most people wait for the headline, major bank fails. By then, it's too late. The pros watch different signals. Here are the specific indicators that tell you stage 4 is approaching. Signal number 1, credit spreads. Widening what it is. The difference between what safe borrowers pay, U.S. government, versus what risky borrowers pay. What to watch? High yield, junk bond, spread over treasury yields. Current, Yammer 4% spread. Warning level, 6% plus. Panic level, 8 and 10% plus. Where to check? Fed database, Federal Reserve economic data, Bloomberg terminal if you have access, free approximation. Compare HYG, junk bond ETF, versus TLT, Treasury ETF. Why it matters. When spreads widen, the market is pricing in higher default risk. It's the bond market saying, we're worried. Signal number 2, bank stock performance versus market. What to watch? KBW Bank Index, BKX versus S&P 500, regional bank stocks specifically. Warning signs, banks underperforming market by 10% plus over 3 months. Accelerating underperformance. High volatility in bank stocks, wild swings. Why it matters, professional investors sell bank stocks when they see balance sheet stress before the public knows. Signal number 3, TED spread. What it is, difference between 3-month LIBOR and 3-month Treasury rate. Normal level, 0.1, 0.3%. Warning level, 0.5% plus. Crisis level, 1.0% plus. 2008 hit 4.6%. Why it matters, measures how much banks trust each other. When banks don't trust each other to repay short-term loans, the spread explodes. Signal number 4, Federal Reserve balance sheet. What to watch? Is the Fed expanding or contracting its balance sheet? Current, 7.3 trillion trend. Was shrinking, QT, now stabilizing. Warning sign, sudden expansion. Despite no stated QE program means emergency actions happening quietly. Where to check? Fed website, H4.1 release, weekly. Signal number 5, overnight repo. Market stress. What it is, short-term lending market where banks and institutions borrow cash overnight. Warning signs, repo rates spiking above Fed funds rate. Need for Fed intervention in repo market. This happened September 2019 as early warning of system stress. Why it matters. The repo market is the plumbing of the financial system. If it's clogged, everything else breaks. Signal number 6, corporate default rates. What to watch? Moody's S&P default rates for corporate bonds. Current, 3 to 4% annual default rate. Warning level, 6% plus. Crisis level, 10% plus. Why it matters. Defaults mean bondholders aren't getting paid. Banks hold many of these bonds. Defaults, or shocker, bank losses. Signal number 7, FDIC problem bank list. What it is, FDIC maintains confidential list of banks with serious problems. What's public? Number of banks on list, not names. Total assets of problem banks. Current, 63 banks, $82 billion in assets, Q3 2025. Warning trend, rapidly increasing numbers or assets. Why it matters. These are banks FDIC thinks might fail. The list grows before crisis becomes public. Signal number 8, currency movements. What to watch? Dollar strength, DXY index. Yen carry trade unwinds, JPY strengthening rapidly. Emerging market currency collapses. Why it matters, sharp currency moves often reflect forced liquidation of leveraged positions. Carry trades unwinding. Chassis and global deleveraging. Crisis approaching. Signal number 9, news narrative shift. What to watch for? Phase 1, everything is fine. Banks are well capitalized. Phase 2, some banks face challenges, but the system is stable. Phase 3, regulators are monitoring the situation closely. Phase 4, emergency measures are precautionary, not reactive. Phase 5, we will do whatever it takes to protect depositors. You're in trouble when you hear systemically important, too big to fail, unlimited liquidity, whatever it takes. These phrases, stage 4 has begun. The timeline. What happens next? Based on current data and historical patterns, here's the most likely timeline. Near term, now, 6 months. Volatility and stress testing. What you'll see, market volatility increases, VIX spikes more frequent. Headlines about individual bank stress. Each event dismissed as isolated regulators providing reassurance. What's really happening? System is being stress tested by higher rates. Weak spots being identified by market, smart money quietly repositioning. Your move: review bank exposure. Where's your cash? Check FDIC limits, $250K per institution per account type. Reduce unnecessary leverage. Build cash reserves. Medium term, 6 to 18 months. Tightening and clustering. What you'll see: credit getting harder to obtain. Corporate default announcements increasing, regional bank mergers, forced or voluntary. Commercial real estate loan defaults appearing. What's really happening? Refinancing, wall hitting. Weak borrowers unable to roll debt. Banks pulling back, lending to preserve capital asset prices declining in stressed sectors. Your move: diversify bank deposits across institutions. Consider safety of investment holdings. Are they liquid? Avoid sectors with high leverage, CRE, highly leveraged companies. Keep flexibility, cash and warrant options. Longer term, 18-36 months. Recognition and response. What you'll see: a recognizable institution fails or requires rescue. Systemic risk becomes phrase du jour. Emergency measures announced. Government guarantees expanded. Potential deposit insurance limit increases. What's really happening? Stage 4 has begun. Contagion spreading, authorities trying to contain panic wealth transfer. Accelerating your move. If you prepared in earlier phases, stay calm. Don't panic. Sell quality assets into the crash. Look for opportunities in dislocated assets. Protect purchasing power. Consider alternatives to pure cash. What you can actually do. Knowledge without action is entertainment. So here's the practical playbook. Immediate actions this week. 1. Audit your bank exposure. Where is your cash? How much at each institution? Is it under FDIC limits? $250K per institution? Is the bank strong? Check bank ratings at Weiss Ratings or Bauer Financial. 2. Diversify bank deposits. Don't keep all cash at one bank. Spread across 2 to 3 solid institutions. Consider credit unions, often more conservative. No FDIC limits apply PR institution, PR account type 3. Review debt obligations. Variable rate debt could increase. Refinancing coming up. Lock rates if possible. Can you pay down high interest debt? 4. Check investment liquidity. How fast can you access your investments? Are they in liquid markets? Do you have stop losses or protection? Short-term actions this month. 5. Build cash reserves. Target 6 or 12 months expenses in cash equivalents, but don't exceed FDIC limits at any one bank. Consider treasury bills, direct from a treasurydirect.gov, no bank intermediary. 6. Reduce personal leverage, pay down credit cards. Avoid new debt, build equity and assets. 7. Diversify wealth storage. Don't keep 100% in financial system. Consider physical precious metals, gold, silver, real assets, international diversification. 8. Secure documentation account statements, asset titles, insurance policies, store digitally, and physically ongoing actions, monthly. 9. Monitor key indicators. Check signals listed in Part 4. Set Google alerts for bank stress, FDIC, Fed emergency. Follow financial news, but filter for signal versus noise. 10. Stay educated. Understand what you own and why. Know your plan for different scenarios. Don't rely on experts to tell you when to act. They're often late. 11. Network and share. Connect with others tracking this. Share information. Learn from others' experiences. What not to do. Don't panic. Sell everything. Panic is not a strategy. Forced selling locks and losses. Don't go 100% cash. Cash is safe from bank failure if under FDIC limits. Cash is not safe from inflation. Balance safety and purchasing power. Don't assume government will save you. They'll try to save the system. Individual savers often take losses, bail-ins, inflation, etc. Don't ignore the signals because you're scared. Fear is natural. Denial is dangerous. Preparation reduces fear. Don't put all faith in one strategy. Diversification across asset types. Diversification across storage methods. Diversification across jurisdictions, if substantial wealth. The uncomfortable truth. Why most people will lose. Here's what history teaches us. The majority always loses during these transitions, not because they're stupid, not because they're lazy, but because of psychology and timing. The psychological traps. Trap number 1, normalcy bias. It's never been this bad before, so it won't get that bad now. Wrong. It has been this bad before, many times. You just didn't live through it. Trap number 2, recency bias. The Fed always steps in, they'll fix it. They'll try. Doesn't mean they'll succeed. And even if they fix it, the fix often involves currency debasement that erodes your wealth differently. Trap. Drawer 3. Authority trust. The government just fed experts say everything's fine. They said that in 2007. They said it in 1929. They say it every time. Because causing panic makes the crisis worse. So they lie or shade the truth until they can't anymore. Trap. Number 4. Complexity confusion. This is too complicated. I'll let professionals handle it. Professionals are playing a different game than you. They get bailed out. They have insider information. They move first. By the time you get advice, it's often too late. The timing problem. Too early. You position defensively. Market keeps rising. You feel stupid. You abandon the strategy. Then the crisis hits. Too late. You wait for confirmation. Crisis becomes obvious. Everyone panics simultaneously. Exits are clogged. Forced selling at worst prices. The solution? Position. Gradually over time. Don't try to time it perfectly. Scale in and out based on signals. Keep enough defensive posture to survive. Worst case, keep enough offensive posture to benefit from opportunities. Closing. The choice ahead. We've covered a lot. Let me distill it to the essentials. The reality. We are in a global debt supercycle. Leverage is at or exceeding 2008 levels. The 4-stage pattern is playing out again. We are in late stage 2, early stage 3. Stage 4 could be triggered by any number of catalysts. The catalysts, what could trigger stage 4? Major bank failure, corporate default wave, commercial real estate collapse acceleration, sovereign debt crisis, US or major economy, geopolitical shock, war, major political upheaval, cyber attack on financial infrastructure, derivative, counterparty failure. See you in next video. Be safe.